for everybody being here today on this Saturday. So we're going to dive into option strategy guide. So, I get a lot of questions all the time on, what are the different option strategies, obviously, and then, when to use which one at the correct time. So for the best results. So I thought I'd put together a kind of a presentation on, how to go about it, when to select the best option strategy and how, and what is involved in it and what are the strategies. So I kind of nicknamed it the OSC, option strategy confusion. Okay, so anyway, again, thanks for being here. And a little background on myself. Started trading actually back in the 80s. Was fortunate enough to get a job at a company called Coastal Corporation, which was an international integrated oil company that had pipelines and oil refining, production, all that kind of stuff. And they would actually, at that time, they were taking in trainees and teaching you to trade, various things like products, crude oil, all the different energy type of components and products. So I was able to get into that program. First, sent me down to one of the refineries that they had in Corpus Christi, Texas. Just kind of learn the foundation of oil. So learning about bringing an oil tanker into the refinery, putting it through the different distillation towers and the process that goes into making the different products. So really good foundation, basically way to start to understand crude oil and kind of the energy market. And spent about 3 months down there doing that. And then they put me into their tanker chartering group and went into scheduling and operations for a while. And then finally got on the trading desk on the crude cargo side, which was a fantastic experience. Sent me as soon as I got there, almost they sent me to Singapore. Spent a couple of years out there trading actually products and a lot of the Asian crudes. And then in the mid 80s, got a job at a company called Transworld Oil, which at the time they were the largest oil trading company in the world. It was Transworld, Mark Rich, and Fibro. They were the three, big international oil trading companies. So fantastic experience there. I spent about 17 years there at Transworld, 16 years in Bermuda, and ran the international trading desk in Bermuda for about 10 years. So that's where I really started trading options, and that's where I really got the foundation of how all this, kind of pulls together to use options in the different markets and just kind of never look back. So it's just a fantastic way to increase your potential profits, leverage, define risk, just so many different things. So we'll talk about the different strategies here today and when and how to use them. So the following workshop presentation is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. So, what kind of are the secrets to trading profits? In my opinion, it really comes down to options. So when we look at trading is a business of probabilities. And to be a successful trader, you need to really understand how to control your risk. And that's what's going to really win the game in the long run. So by knowing and better understanding how to manage and control your risk, it's going to really make a dramatic and positive difference in your trading performance. And one of the best ways to do this is through the use of options in your trading. Now, options have so many more advantages than trading just stocks outright or our futures outright, but can be a little bit confusing and debilitating, to traders or investors unless you know which option strategy to use and when, and then how to use it correctly. So, and then it all comes down to based on the market environment you're trading. So, it can be a debilitating kind of trading dysfunction and kind of what I call the option strategy confusion. Now, options were first put together to use as hedges, for hedging, different agricultural products and bonds. But over the years, they've become a really big way to speculate. But, we're going to talk about, a lot of different strategies here today that are also great for hedging and also great for profit generation. So when we look at the option strategy guide, what we're going to go through today, it's what you kind of need to know to successfully trade options. So you want to get out of that option strategy confusion. None of that anymore, right? So let's kind of go through a few steps here to kind of help clarify the whole process. So step one is you want to know, how option pricing works. So once you understand the option pricing dynamics, how it works, then you're going to better understand the different strategies and how to apply those strategies. It's just like anything else. If you're tinkering with your car, you're a mechanic or whatever, you want to understand how the different components of the engine work, and that's going to help you better understand the car and the way it operates. The same with options. So when we look at the option pricing model, it really comes down to the most important factor becomes time and volatility. So we have what we call time decay, and then we have the implied volatility. And these two components are two of the main pricing components that help to derive the value of an option. So basically, time is what we call the extrinsic value. So it's the time value component, extrinsic value of an option. So it's the premium that a rational investor is going to be willing to pay over the current exercise value, the intrinsic value based on the potential to increase in value before it expires. So it's this change in the value of your option based on time decay. We can actually measure it theoretically using the Greek, what we call theta. Now, time decay then is always going to work against buyers, but it's going to benefit the sellers. So that's because option theta has what we call either a positive or negative value to it. So when you look at all long stock options, so if you're long a call, if you're long a put, those positions are going to give you what we call a negative theta value, which makes or indicates that you're going to actually lose value on that option if you're long as expiration draws near. So it's a decaying kind of component of the asset. So, but then the reverse of that is all short stock options. So then if you're short that call or if you're short that put, you're actually going to have a positive theta value. So it's going to actually benefit you if the market's not, or your underlying's not moving and kind of going sideways. You're actually gaining value from that position from being short that option. All right, so you have that positive theta value versus the negative theta value if you're long a call option or a put option. Now, many options trading strategies will also look to sell out of the money options on top of buying at the money options or in the money options. And that's done in order to offset that negative theta decay. So this results in a lower rate of time decay, and also it's going to lower your capital at risk, the money that you have on the line for that particular trade. So I always like to do spreads. Now we can go long calls or puts, but I prefer using spreads, which we'll go through a bunch of examples and you'll see why. Now, when we look at the strategies that sell additional maybe calls or whatever or puts above your long strike, this is what we're going to talk about here. Is called the vertical bull call debit spread is one. So that's where you're going to be long a call and then short a call against it. Or we have a vertical bear put debit spread. So this is where you're long a put but short a put below it. So that's going to reduce that theta decay and also that capital at risk. And then we have the butterfly spread, which is very dynamic. And then we have kind of what we call the long condor spread. So these are kind of some really great option spread strategies that will not only help you to reduce that theta decay, but they're also going to reduce your capital at risk or the risk that you put up on a specific trade. Now, when we look at the other major pricing component, this is volatility. So the implied volatility part of your option price component or value is going to be expressed as a percentage of the stock price. So it's basically indicating a 1 standard deviation move over the current or over the duration or option cycle of the specific option series you're trading. So in theory, a stock should end up within a 1 standard deviation range of its original price 68.2% of the time during this option cycle period. Now, this is a theoretical probability, but it's a forecast then of your security's price range, and this should always be a part of the process used for selecting then the highest probability price targets for any trade that you're taking. So we always, before we ever put on a trade, we'll always look at a price forecast based on this kind of probability analysis to give us kind of a theoretical price that we could potentially theoretically achieve, over a certain option cycle period. Now, when we then put all these components together, this is going to give us what the value of your option would be. So it basically comes down to these three kind of components. You've got the time value times the implied volatility times your underlying security value, the intrinsic value. Now, once you know these variables, then you're going to be, able to price out the option, and then have an idea of, what the option premium should be, and then what option strategy you may want to use. So here's a really good little outline of how these components flow through. So this is like time value, and so when we look at the pricing components, we've got the time value component times the implied volatility of your underlying security times the value of the intrinsic value, and that's going to give you the value of the option or your option premium. Now, most options are going to have weeklies, and some of the ETFs have dailies, but most all the bigger underlying securities will have a weekly option. And so every Thursday, we get a new option series. And on that first day, we have 100% time component or value in that option price, okay? So then if you just look, I just plugged in some different values here. So let's say we had the implied volatility was like 300. So we have that times 100% of the value, time value, and we left this constant. So you can see your value of your option would be $300. Now, when you come back in, say from the weekend, even over holidays and weekends, you're going to have that time value hitting your option. So let's say we come back in on Monday, you can see the time value component then has been cut in half. And even in this example, I spiked it up, the implied volatility to 800. Then you can see with this being constant, your value of the option has only increased up to $400. So when you first started, it was 300, and now it's only 400 because that time component is really starting to decay. All right, so even if we put in, let's say we put in an implied volatility of 200, then you can see your value of your option would be only 100. So at the end of your option cycle series, when it expires, the two major price components go to zero, all right? So time goes to zero and your volatility go to zero. So this is why, a sell side component of option spreads really is beneficial, or just kind of selling credit spreads can be a really great way to generate some income. But that's the main feature, is that they both go to zero. We want to take, or at least be aware of it, but try to take advantage of that time decay and implied volatility component going to zero. Now, the second step is then trading time. Now, we can actually trade time by selling time to take advantage of your options time decay, or that theta. So if by selling options, you're basically, in essence, selling time, and you're also selling volatility. So when you sell an option, a call or a put, you're selling time and volatility by doing that. The other really good way to think about an option is think about like a coupon that you get at a store, and it has a certain value to it, but you have to use it by such and such date, or else it's no longer be able to be redeemed or used. So that's exactly how an option is. We have the different option series, and at the end of that series or expiration, they're no longer valid. Okay, so just like a coupon that you would get. And so this is a really good illustration too of that time component. So when we look at an option and we go way out in time, let's say we go out 120 to 90 days out, the time component or decay is very, very small. You can barely even see it. And so mathematically, it's very, very small. Now, once you start getting closer to expiration, or that day zero, and especially when you get 30 days out, that's when it really starts to decay and accelerate. So that's where we can really then take advantage of these weekly options to do a lot of different type of spreads to enhance the capital at risk, to lower that, and also to help us in lowering that theta decay. So that's a lot of things that we will do, or adjustments on trades are going to be based on trying to improve our theta, give us a better positive theta, or improve the theta, or reducing our capital at risk, making us have a potentially larger return on the capital that we have put up. All right, so that shows you, that illustrates that time graph and how it really starts to decay and fall off quickly. Now, step three is you want to understand the probabilities. Okay, this is what I kind of refer to as the market maker's secret. It's what they don't want you to understand, and it has to do with these two pricing components, volatility and time. Now, the option markets are going to use mathematical market probability statistics for pricing the movement of your option to its expiration. So by knowing the probability of an underlying security you're trading finishing within a certain price range at expiration becomes key to then determining what options you're going to either buy or sell, and then which option strategy to use. Now, these statistics then forecast that how likely it is that an option will fall within a certain option series price range, up or down, by its expiration. And this forecast is what we refer to as the implied move of your security or stock, or the implied expected move. And so what it represents the theoretical kind of implied move estimation of one standard deviation of your underlying security, theoretically, by its expiration. So that's what I kind of refer to as a normal move of the security you're trading based on the option cycle, would be kind of one standard deviation either up or down. So when we look at selling options, here's a really good example of how to kind of view this. Now, if you're selling an out of the money option, one standard deviation out of the money statistically, you're going to start out theoretically with an 84% chance of winning. All right, so it's based on these probability statistics. So if you look at, this is a normal distribution curve, and at the top of it is the at the money price. So let's say XYZ is trading at $500, and we have 10 days on this option until expiration. Okay, now if we were to sell a one standard deviation price point out of the money, and we can base that on what we call the option delta, that point right here would be, in this example, about 520. So this is going to represent like a 16 delta, a plus 16 delta. All right, so what that then can kind of back into is that when we look at a delta, say a delta of 1, that's one way to think about it, is that's equivalent to you owning 100 shares. All right, so remember, one option contract is equivalent to 100 shares. So if you have a delta of 1, that's like you actually are owning and controlling 100 shares. All right, so if you have an option delta of 100, and then you were to sell a short strike, say in this example at 520 with a delta of 16, then you're going to see the reciprocal of that is 84. So you can look at that and view that theoretically there's an 84% probability that the price will be below 520 at expiration. So let's say if that was 10 days or whatever it might be, days expiration. All right, so that's a really quick way to assess probabilities of your trade being a winning trade or losing trade. And the same applies for the put side. So if you were to sell that 480 put, there's a then an 84% probability theoretically that the price will be below 480 at expiration. So this is how we can quickly measure probabilities of a trade. And so what I like to kind of refer to this range here is kind of what we call the one standard deviation price range. Now that's then a normalized move. So if you're trading right here at $100 or whatever, so let's say one standard deviation here is up to 50 bucks, 150, or down to 50, that would be a normalized range. But then when you start seeing you go out the curve, then the probability of it hitting price points as you get further out of this range is smaller and smaller. So here's like 2 standard deviations. There's only about a 3 to 5% chance that price will get to that, 2 standard deviations. So this is where we can quickly then assess probabilities of trade, having a chance to be a winning trade or higher chance of being a losing trade. And here's another kind of good example of option delta. So this was like on Apple, it was trading $190. And you can see here, if you look at the $190 strike, you can see the option delta here says 0.52. Let's say it's 50. So basically it's like flipping a coin. So you've got a 50% chance that the price will be at 190 or below, or 50% chance of 190 or above. Now, when you go further out the curve, let's say we go out to that 215 strike, you can see it shows an option delta of 0.5. And then you can see here, this is what we call probability out of the money. So that's then showing you theoretically, that shows 95% probability out of the money. So if you were to, let's say, buy that 215 strike here, you've only got a 95% chance. There's a 95% probability that price will actually be below 215, or you could say I've got a 5% chance that price could be at 215, or you can look at it the other way around And if you sold that 215 short strike, you've got a 95% expiration. It could be one day, but typically we'll look at about a week, okay, to really, take advantage of that theta. So kind of the week is a sweet spot, 6 to 8 days, something like that, is a really kind of the sweet spot for these trades, okay? Yeah, thanks for clarifying that, Bill. 7 years. I said 12 years. It's 7 years. Sorry about that. And so that once more, so I'm just checking all the. Yeah, okay. So that's a look there. Now the next step is the process. So what we want to do when we're trying to select the option strategy is we want to. We want to look at, what's going on in the market. So we want to, first thing I always like to do is I want to identify the market cycle, okay? So do we think is the market, are we in an uptrend, upcycle, uptrend, downtrend, or sideways? Or you maybe have no idea. We've had a lot of uncertainty lately, but we want to try to determine the market cycle. And then we went to, the next thing I like to do is identify the chart pattern. All right, so when I say chart pattern, I've got 5 different type of chart patterns that I look for. And these are high probability, winning chart patterns that I've used over the years and years and years I've traded. So I've kind of defined exactly what they are, then I know what to look for. And then based on that chart pattern, it'll give me a good, clear idea of the best option type of trade or strategy to use. So that's kind of the second step of the process. And then the third thing you need to do is you need to know, what is your time horizon? What is your duration of the trade? What are you looking for? Are you looking for a real quick in and out, a short time horizon? Are you looking for this maybe a longer trending trade, thinking this thing has a lot of potential upside or maybe downside? You're looking for a trend, continuation trend. So that's going to be really important. Your trade duration, your time horizon. So that's kind of a key step that we want to identify and clarify before we put the trade on. So when do you expect that trade to make money? Okay, is it going to be today, tomorrow, next week, or next month? Okay, so really important. So this is a big part that we'll go through in the course next Saturday, starting next Saturday. Then the next thing is your capital at risk. So this is going to be a lot of times based on the market conditions you're trading. So when you're trading a really high volatility or higher volatility market with lots of uncertainty, which we're kind of in now, obviously, it's a lot of uncertainty. You want to really control that risk. So there's certain option strategies that are going to be better for your risk versus other types, okay? So we can really structure and reduce our risk kind of to low risk, medium, or higher risk trades based on the market condition. This will dictate then what maybe the best option strategy would be to use in that kind of market condition. And then what is your goal, your objective? Are you looking just for some passive income, just to kind of bring in each and every month or week, from the market, or are you looking for more, decent profits that you can get on your capital at risk, or are you needing hedging? In this kind of market, you really want to understand how to hedge what you already have on, or are you looking for capital gains? So what are your objectives of trading or investing, and that's going to dictate to them what might be the better option strategy to be using. All right, so here's kind of the go-to strategies that I like to look at and use. So first, these are all going to be based on the market cycle we're going to be trading in, so up, down, sideways, whatever, and also then based on that market condition. Are we in low, extreme, or high uncertainty volatility? Now, the trades that I like to look at will be just strictly long calls or long puts, all right, or a vertical debit spread. All right, so lot of vertical debit spreads, like those a lot. Or we may want to look at a vertical credit spread where we're just collecting premiums. So these are what we call probability trades based on that theoretical probability analysis that we kind of touched on. And then another really unique one is what we call the butterfly spread, which is a very, very low risk but high potential payoff reward type strategy that really takes advantage of selling side component of time decay and implied volatility. And then we have what I call the cousin of the butterfly, the long condor. So not to be confused with the iron condor, but the long condor. So we do a lot of these. These are a great strategy. And then the other one that we do a lot of is the calendar diagonal. These are fantastic trade setups for giving you a little bit more potential time you can trade or stay with the trade, and what we call, buying something at a discount. So we can actually, use this to amortize down the cost of our trade, kind of like a covered call. So these are kind of the main kind of go-to strategies I like to go to. And for the alert service, the main strategies, the main alerts that we typically will do a lot of calendar type trade setups, butterflies, long condors, from time to time debit spreads, from time to time credit spreads. But these kind of three are kind of the main bulk of everything that we tend to go to, kind of the go-to trades, right? All right, so those are the ones. Now, if we're doing a long call or put, here's some kind of good stream, kind of guidelines that you can do and use to make it really kind of simple. So when you're looking to, you can do this for day trades, swing trades, trades that could be 1 to 10 days out, or longer term trades. But these are great for controlling your risk. You know what the risk is, define risk. But when you're doing these, generally what I'll look to do is I'll buy the if you're doing a call or put, I'll buy like at the money, like a 50 delta, or maybe a little in the money to 70 delta, right? So that's kind of general rule of thumb. So you buy that 50 delta to 70 delta, and then you're, going to be, if you're looking for an upside move, you're going to go long calls, downside move, long puts. All right. So that's kind of a nice kind of summary of, what you can potentially look at, to set those up. Now, then the other one is the vertical debit spread. So this is a combination of, you buying a call or buying a put, but then selling another call or put above it or below it in order to reduce your capital at risk and also reduce that data. These are really good for swing trades, all right? Swing trades or even longer term trend trades. So it's going to give you very defined risk. You know exactly your debit paid is your risk. And so this is going to be a lower capital at risk type trade. It's going to have a little bit lower time decay. It's not going to have a positive time decay. It's still going to have some time decay, but it's going to lower that time decay. Your upside profit is capped, but also your risk is capped. So these are a great, really great option spread strategy. And then the other one is the flip side, the other side of the debit spread is the vertical credit spread. So this can be used when you're for day trades or swing trades as well. And this is going to be something best used when you have a higher implied volatility, because remember your component, your value of your options based on the time component and volatility. So when volatility spikes up or goes up, you're going to get more premium when that implied volatility goes up. So that can really help if you're selling credit spreads. So again, though, it's going to be defined risk. This really takes advantage of time decay and that implied volatility, what we call crush. These are really best used for kind of sideways price action markets, and you're going to have a cap trade on that as well. But the only thing with the credit spreads is your profit is just your premium received. So you're not going to have, unlimited profits like if you just bought a call or put, or a bigger positive we call risk ratio if you do a debit spread or other spreads. So this is going to give you a negative, what we call a negative risk ratio, which we'll go through here in a minute what that is. All right, so those are kind of three to start with. Now, your vertical call debit spread, or you can do calls or puts, but let's say we want to go long and go for an upside move. So in this example, we're long a call, short a call, and so it's a cap risk trade. Our risk is going to be the debit paid. So in this example, the debit here is $300. Now you can see the spread here is in this example would be like long that 10-10 call and then short the 10-20 right there. All right, so it's a $10 wide spread, 10-10 to 10-20. So remember, one option contract is equivalent to 200 shares. So that's $10 wide. So this would be like $1,000 wide spread. All right, so the cost of the trade, the risk is your debit paid of $300. Now then the difference would be your potential profit of $700. So at expiration, if it closes at your short strike of the spread or above your cap, you're going to make $700. So that would be a return of 233%. So 700 and you're at capital at risk 300, so 233% return. So that's what we call it. That's a positive risk ratio. So we're risking $1 to potentially make $2.33. All right, so nice little spread. Now, this is going to give you a less theta decay than if you're just long that call, but also will still have a negative theta. All right, so to point that out. Now, the other side of the coin is if you did the call credit spread. So in this example, you're selling that call, let's say the 1020 strike here, you're selling short that, but you're going to buy the 1030 above it to cap your risk. So when you're doing credit spreads, if you're just selling a call or selling a put naked, you have unlimited risk up or down, right? So this will cap that risk. Okay, so in here you can see it's a $10 wide spread. So the spread width then is $1,000. Now for doing this spread, you brought in this example $200. So that is your premium that you brought in. So that would be your profit on the trade, just the premium received. But your risk is the difference of $800. So you can see here, you're risking 800 to make 200. So that's what we call a negative risk ratio. So I'm risking $4 to make $1. So you might think, well, why in the heck would I ever do that? Well, these are what we call probability trades, right? Talked about that a little earlier. If you're selling, one standard deviation or further out of the money, theoretically your probabilities are going to be, more in favor of the trade the further you go out, and we can measure that by the, option delta, that kind of thing. All right, so that's just a kind of outline there of a credit spread. So you can see the difference, okay? Now the butterfly spread is very unique. So what I like about spreads are the combination. All right, so the butterfly is one where we're going to be buying and selling options. So it's basically a vertical debit spread with a vertical credit spread put together. Okay, so it's a combination. I call it mixing and matching. This will give you a defined risk trade. It'll be a debit trade. So your debit paid is your max risk. So this really takes advantage of time decay and implied volatility crush. We both know at expiration, they both go to zero. This will give you a positive theta, no time decay. So if you do butterfly, always have positive theta, no time decay. These are great. The way we will use these are directional trades, but that could be non-directional where you just try to catch that premium. Typically, it could be 1 day to kind of 2 weeks out. Don't like to go much more than that. 2 weeks, the way that they are structured, you don't really get the big payoff until you get closer to expiration. So you're kind of what I call sometimes dead money if you go too far out. These are great for giving you the high of all the different option spread strategies. The butterfly will give you the highest return on capital at risk of any option spread strategy there is. So I'll show you some examples here where we've come close to 2,000% return, on a trade that we've set up, okay? And these are also great for hedging, all right? So when you get into a trade that starts to go against you, the butterfly kind of hedge can be a really great one to quickly execute, and lower your risk, lower your theta, things like that. So just a fantastic hedging mechanism as well. And then the next one is the butterfly. So if we look at this butterfly trade, just kind of think back to where I showed you that call debit spread. So you're long the call, short the call here, okay? $10 wide, $10 wide, okay? So you've got it. So the spread width is $1,000 wide on the long side. All right, so your long call, short call. Now, if you sold that credit spread here, sharing that same short strike, that just created a butterfly. All right, so now you've got, and that side is $1,000 wide, right? So the spread is $10 or $1,000 on each side. Now your risk, if you did that debit cost here of 300 and you added that credit spread and you brought in 200, now your risk is $100, all right? So you've reduced it down to 100, and that's your max potential loss. Now, if we go what we call the top of the tent here, that would be your max profit, but you have good profit potential anywhere inside of that tent. All right, so this can give you, in this example, if you hit it right there on that nail, right there at expiration, your return would be $900 on your risk of 100. So that would be a 900% return, okay? So that's what you're looking at there. So you can see the huge impact and dynamics of this kind of strategy. Now, the next one is what we call the long condor spread. So like the butterfly, it also combines buying and selling options. So it also combines doing a vertical debit spread joined with a vertical credit spread, okay? And these are great because we can leg in, leg out of them if we want. But what the long condor does, not an iron condor, it does not share the same short strike of the verticals, okay? So what it does is it moves the vertical credit spread side short strike further out of the money. So this gives you a bigger profit zone versus the butterfly. All right, so really great trade strategy. We do a lot of these. So it gives you that bigger profit zone. This will always also give you the positive data, no time decay. These are great for 1 to 2 weeks out, kind of the sweet spot. The good high positive risk ratio, low capital at risk, also really great for hedging. All right, so the long condor, so we can use it with calls or puts, to shift our directional trade up or down by using calls or puts for the long condor. Now, the other one that is a really fantastic strategy that we do a lot of, these are what we call the counter diagonal. And this is another one to use in certain market situations and market conditions. Okay, so this is a kind of really, and this one just think of if you've ever done a covered call. So instead of buying the shares, in this one you're going to buy the options. So it's going to be much cheaper, and we can do this with calls or puts. So it's more of a medium to, or it could be a long-term directional type of trade that you're doing and using the strategy. And so with this strategy, you're speculating on trend, but you can also do it for setting up hedging. All right, so it's a vertical, basically what it is a vertical diagonal debit spread where you have your long option leg set further out in time versus your short option leg, which is closer to expiration. So again, the closer to expiration, right, the more accelerated the theta decay will be. All right, so but if you go further out in time, if you're long an option, either a call or put further out in time, you're going to have less theta decay than if you're closer in on short duration. So this gets the benefit of less theta decay from being long further out in time, but we're going to be short against it a leg closer in. So it's kind of like a debit spread, but instead of being long and short in the same option duration, we're going to have the long leg further out in time, so it's going to have a lower theta decay, smaller theta decay, but the short leg is going to be closer in to expiration. So we're going to have that accelerated theta decay. So this can really be a great way to take advantage of short-term weakness or strength that we think will eventually over time revert to our trade bias. So let's say we had a trade that we think it's going to take a while for it to churn and then it's going to break to the upside. We can do this strategy that we're getting paid while we're waiting for it to kind of break up. We're not getting that theta against us, like a covered call. So we can just keep rolling the spread, the short strike. Okay. So really great strategy. So, but we can do this also with puts. If we think the market's going to go down, but we think it's going to take some time, we can do it using a put counter diagonal. So this gives us time to let the trade direction kick in. All right. So we've got that time factor, into our benefit of the trade versus not having to worry about running out of time and the options expiring worthless. So it takes advantage of the accelerated time decay characteristic of your front short dated that decays at a greater rate than the long backdated option part of the trade. So plus, the big plus here is that it gives you a positive volatility difference between the option series. So if we have a positive skew, which we'll talk about in the course, that's an added advantage of this trade as well. And then the other big component or big positive additional benefit is that you've got the vertical spread component part of the trade. And that's what really adds the directional element for giving you some really great big profitable trades. So with this kind of strategy, I call it buying options at a discount. So again, if you've done covered calls, you're long those shares, you sell calls against it, and you just keep, as long as your underlying stays within your support range, you just keep selling shares against it. If you did it over and over and over and over, eventually you could actually amortize your costs down to zero, right? So this is a similar situation, but instead of owning expensive shares, we're going to own options, and so they're going to be a fraction of the cost of if you own the shares. So great place to leverage up returns, but also control your risk and amortize down the cost of your trade. So this is a good diagram to kind of illustrate what these, kind of visualize what they look like, how they work. So think about this. If you have just a vertical debit spread, let's say we did it in the option series for next week. What is next week? 7 March. Okay, let's say we did this in the 7 March series. So you're long a call here, short a call. So both parts of the spread are in the same option series, but with the vertical calendar spread, diagonal spread, we would be long this, say along the call side, maybe out here on the 21 March series. Okay, so further out in time, so we're going to have smaller theta decay, but then we can be short this call here in the 7 March series. All right, so this is going to get the accelerated theta. Now, if we don't hit our short strike here, then we can roll to the next year series. Then we can resell the 14 March and go from there. So really dynamic, gives you a lot of different ways. I call it a flexibility trade, a lot of things we can do with the adjustments. So love that trade setup. We do a lot of those. So let's take a look at some examples. So I'm going to go through here with a number of different examples to give you a better idea of what they look like, how they work. So we'll look at a vertical debit spread, butterfly spread. We'll look at the long condor spread. We'll look at a calendar diagonal. So the trade examples too that I'll show you, these were all alert trades that were sent out to our alert members. Okay, so you can see these were trades that we actually did. And so it gives you a good idea of what you could be looking at as far as how these work. And again, the course that I'll do next weekend will show you in more detail how each of these different trades work, spreads work, and then how, when, and why to use them. What time frames. We'll go through in greater detail that process that I just briefly outlined. So here's one that we did. This was for a short trade. So this was doing a long put debit spread. Okay. So did this on SPY to short SPY. So again, why do it? Well, it's going to give us a structured trade for defined risk. In this example, a defined risk trade is shorting the market. It also can be used for hedging, used for swing trade, breakout, reversal type trade setups. Duration, typically, it can be shorter, but 1 week to 1 month out. It could be your duration. This will lower that theta decay. Capital returns, typical of these are 1.5 to 1 to 3x. Okay, so 150% to 300% kind of returns on your capital that you put at risk. So that's kind of the summary of what they will do, the benefits. So here's one that we did. This was a short trade setup, and just we were looking to short SPY, and then at that point, SPY was trading at 549. So this was said a new SPY retracement failure short. So basically what happened, SPY went up and failed. So we'll be probably looking at this type of trade setup for next week, because if I have time, I'll show you. Well, I'll show you real quick what we'll be looking for, and I'll pull up SPY. 1 second. So basically, these are great for short trades. Let me just show you kind of an example of this, what I'm talking about, a retracement failure. So when we look at next week, you can see we had a big, obviously, sell-off. If you were here, you know that. So you can see we had a rebound here, but now what we're going to be looking for in the market is, can this maintain this commitment to this move up? So we've got all this moving average resistance up here at 600. So if this market, let's say the SPY gets up here to this area here, 600, and then starts to fall back down, that'll be a great place to short the trade. So it's a retracement failure short. So that's what this example was. Okay, so this is the condition of the market, perfect for that. And so we set this up, but it was a very defined risk trade. So I put in the target. First target was going to be 543, 537. So this was buying a vertical put debit spread, the 548, 543 at around $1.35. So $135 was your max risk. And then, the thing, this was in 1 day, then it cratered, and now it's traded at 539. And, we were up on this trade, up a really nice profit on this trade within 1 day. So this was actually kind of a short-term intraday trade. So here was the trade setup. It was trading right here when this was set up, 549, and then it was breaking. See, here's that moving average failure. So this was a 50 simple moving average it came into and failed. So similar to right here, see that 50 simple. So if we get a move up here in this area here and it fails, this might be something to look at. All right, so my momentum indicators are down. Anyway, that was described in the trade. So a trade with momentum. And if you want to, if you do sign up today for your for the course next weekend and you want my indicators, you can add these exact same studies for $195 and you'll get that discount as well. All right, so my momentum indicators were negative cycle 1 and 2. We had a reversal right there. And so it was set up as 549. Now it was trading at 539. So did this put debit spread and set this up. It was doing the 548 put short to 543. So put debit spread like that. Spread width was $5 or 500. So we've got 548, 543, $5 wide spread, 500. Cost of the trade was $130, $1.30. So your max risk is your debit paid, okay? So 130, potential max profit, 370. And this was, that would be a 284% return on your capital at risk. And this also will give you a lower, so rather than buying puts, we were able to also, the reason to do it this way is we're gonna lower our theta costs of the trade, okay? Now, then took the profit right here. You can see here is this is the risk profile of it. We'll go through analytics and how to use this in the course next weekend. So it's trading right here, on the 6th later in that day. And so this was went from $1.30 spread where we originally set it up, 130. Now it's trading at $361 and spread had blown to 361. So this was up $231, 177% return. All right, so that was, intraday. Could have left it on and had for expiration, but but the market was really volatile. Take your money and run. So that's a really good example there. And on the utilizing a put debit spread in that situation. And let me get rid of this. Okay. Now the next one is a wide wing butterfly. So this is going to give us a really good wide profit zone. Really great when we get into higher volatility markets because we can keep our trading risk lower, reduce it really well with the butterfly. Great for trading high price stocks, lowers the capital that we need to put up for that. Defined risk, great for hedging. Targeted directional swing trades is kind of primarily the way we like to use them. Great for pinning, for expiration series of monthly or even weekly. Great for high volatility markets, kind of more so which we're in right now. Trade duration could be in for 1 day up to 2 weeks, something like that. Always a positive theta, no time decay. Return on your capital of 2 to 1 up to 10 to 1, sometimes 20 to 1 is not out of the picture. So here's one that we had set up. This was on a short trade again on QQQ. So this is a wide wing put butterfly spread, $10 wide or $1,000 wide spread. All right, so QQQ was trading at 314 when we set the trade up. Right here, it's trading at 314.60 right there. Okay, trading right there, 314.60, right in there. We have all of our indicators were rolling over. Okay, so we did this trade setup. And then on the 26th right here, it was trading down at 304. All right, so, pretty quick trade, on the 23rd and out 3 days later. So set this up, going long the 314 put. We were targeting the 304 put and then 304 short, long the 394. So wide wing put butterfly. So $10 wide, 314, 304, 304, 294, $10 wide, $1,000 wide spread. Cost of the trade was $2.10 or $210. The potential profit, if it went out right there at your top of your tent, 304, your target, your body, your potential profit would be $790 on your risk of 210. That would be a return of 376%. So you're risking $1 to make $3.76. So if you just did the ETFs, and you made that $10.60 per share, that's a 3.36% return versus this being a 376% return. So we can even get bigger returns than that, which I'll show you in a minute. So really cool spread. And then you can see here's where it went out. So we had a big wide tent. So this is a really wide butterfly to give yourself a big profit zone in here. But this was going to give us positive data. Low capital at risk or maximum risk was $210. And then you can see it's going to give us the advantage of time decay, that positive data. Volatility class, everything goes to zero at expiration. Low defined, high return capital high return on our capital at risk. And so this trade was ended up making $572 per spread, on our risk of $210. So you can see this trade. Let me erase this real quick. So a really great return on the capital at risk. We made 572 on the risk of 210. So we had a 272% return versus if you just did it with the outright shares, the ETF is a 3.6% return. So there's where it went out, right there in that profit zone. Now here's another really great example of how the butterfly can give you these enormous returns because the risk is so low. And this is one that we did a penning. This is a butterfly penning trade that we did and set up on Tesla. And this was a spread that was spread width on the trade was $250 wide spread. And we set the trade up for $12 was the risk. Okay. And so this is, from time to time, we'll see these kind of trade setup examples that we might be, try to take advantage of. So this was back in February. We did we went long. Right here, Tesla was trading at 189.35, and we were looking for a potential pin. This was not this February, but last. And we were looking for Tesla to move to 200 based on a lot of different things we'll look at. So we went in and set this up. It's what we call a binary monthly option pinning trade. So it's trading at 189.35, and so we did the 197.5, 200, 202.5. call butterfly for $12. Okay, that's the maximum risk. Is unbelievable. And then fast forward, here was the 16th day of expiration. Now we've got a Tesla that now is trading at $200. So trading right at our target, our body of the butterfly. And so now the spread was now up to $215. Our total capital at risk was 12. This was up 1,791% return. Now, at the end of the day, this thing actually pinned at $200. So at the end of the day, this thing was up, max profit, $230 for a return of 1,960% return. So that these things are possible. Somebody might say you're full of it, but if you risk $12 and you make 230, that's a 1,916% return. So these are, these types of trades are possible for these kind of returns. All right, so here was the trade setup. Right here, we were targeting 200, a lot of different things we were looking at, but that was the target area. And so did the body of the butterfly was targeting 200, so bought the 197.5, sold the 200, sold the 200, bought the 202.5, that butterfly like that. 12 cents was the debit cost, 12 cents, or that's $12 per one option contract. So if you did one butterfly, that's 12 bucks of risk. You did 10, 120, but here it was, your spread with the 250, less your cost of the trade, potential to make 238, 1,983% possible return, but anywhere in between there is still a fantastic trade return. All right, so this is just for certain conditions of the market to use this kind of strategy. All right, so here it was going out right there at the end of the day, right there, perfect at 10 bucks. So it went from 12 cents to 250. So there's your, $238. Now we'll scale out, but that's where it was right at the end of the day. It was up 1,983% return. And then here's one that we did just recently. This was NVIDIA. This was another great trade strategy. It's what we call the call condor. We can do calls or puts. But this one, again, is going to give us a wider profit zone. See right here, but it's also going to give us a very defined risk trade, but positive data and low capital at risk. So really great trade strategy to use. And of course, then we'll show you when, what's the best condition, how to set it up, and, which trade works best in those certain markets situation based on those chart patterns, based on the conditions, et cetera. So everything's going to be gone through in the course with the, set process. All right. Again, this gives us a wider profit zone than the butterfly. Gives us, again, defined risk, great for hedging. We can leg in, leg out of these types of trades. So we can use it for hedging, which we'll go through in the course how to do this hedging with the butterfly or condor. Fantastic for swing trades, wide profit zone. Also great for high volatility markets because we can really reduce that capital at risk. So trade duration, 1 to maybe 3 weeks out. Positive data, time decay returns on these are typically 2, maybe 4%. That's about as max that you can get is about 4%. But great return type trade setup. So these are very, very flexible trades as well. And here's one that we just set up not very long ago. So this was on the 13th, and we did this in NVIDIA. So it's trading around 133.98. And this one we had what we call a daily cycle low retracement reversal up to 150 day moving average. And so it's breaking back up. So we set this trade up, looking for a move towards the 50 simple moving average, et cetera. So we had my targets in there, 141 up to, looking for 140, 141. So we bought this condor. So bought the 21 Feb, 134, 137, 143, 146 condor at $1. All right, and here it was on the 21st. Now it's currently trading, went from 133.98. Now it's trading at 140.17. And this trade was then up $170 per spread, 170% return. And then going out, it was up, it was trading at 139.22. It was up $185 per spread, 185% return. So these are a great way to control your risk, control your theta, and just a really good go-to strategy. So this is a big one that we'll be really going into in great detail in the course. So set this trade up right here on the 13th. All the indicators are giving us a movement to the upside. So went long right here, had this move up here. We had this, so this was kind of a cap trade. So we had this range in here we were trying to play. And so it went out right in the center of our range. Right there is perfect. All right, so it's like this. So it went right out, right there in the center of the trade where we want it to be. And so we were able to take advantage of that time decay going to zero, implied volatility going to zero. And that's what the structure of the trade made it work so well. So we were long the 134, short the 137, called the debit spread side, and then short the 143, 146, called credit spread side. So that's the condor. Total risk on the trade was $100, $1. Spread with 300 less 100, $200 would be a potential profit, 200% return, positive theta, low risk trade. And so that's where it went out right there. So it went out, on the 21st, it was trading at 139.57, and had profit went from $1 per spread to $2.89. So up $189 per spread, 189% return. So that's a look there at how those things work. So that's kind of a review of the different ones I'll be going through next weekend, but much more detailed based on that process of, okay, should we use a debit spread in this situation? Maybe we should use a butterfly, or should we use a call condor or calendar? So, why use which in which situation? Now the next one is another one that we do a lot of these. These are what we call the calendar diagonal. So these can be used with either calls or puts, based on the direction we're looking to trade. This is one that we had done with the CCJ, which was a kind of a uranium stock. And so these are also great for defined risk. These are great for selling time and volatility. It's going to give us a positive theta with this type of trade. And the thing that's so great with this, I kind of call it a flexibility trade, is that we can use this to collect income and basically get paid while we're waiting for the direction to kick in. So if the market, we're kind of waiting for it, we think it's going to go up, but it's going sideways, and then we think it's going to go up, we set a counter diagonal up, we get paid while we wait for it to kick in, or it could be we're, getting paid while we wait for it to roll over. So we can do it either way, calls or puts. We can do this, 1 week out to months. We can even go leaps. We can go out years and do this kind of trade. So great trading for great flexibility. We do the adjustments to bring in the credit received, and then that pays down or amortizes down the long dated, either call that we're long or put that we're long, positive theta, no time decay. So fantastic, fantastic trade setup for your trading portfolio. And here's one. This was on CCJ, so it was traded traded at $53. So we set this up on the 21st, and we did a couple adjustments here. We did an adjustment the next day on the 22nd, and then we had some profit take on the 24th. Now this was a fairly short one, but again, like I said, we've gone out 2 or 3 years on some of these trades. So these are a lot of different ways we can do the counter diagonal. So CCJ, is a new CCJ long. It was trading around 53 bucks. Daily cycle low retracement reversal off the 200-day, breaking back above the 21. That was the setup. So we're looking for this thing to move more to the upside, but we wanted to have some time for it to potentially work out in case it did start to stall out. So here's what we did. We went out and we bought the 7 Feb 53 call and sold against it the 24 Jan 55. Okay, so kind of like a call debit spread, but different trade duration for the different legs. So set this up initially at $1.95, $195 per spread. Then on the 22nd, we did an adjustment. It was traded at $54.80. Then we did on the 24th. Now we had it was moving up to our target area. So now it's trading at $58. And so after the adjustment that we did, now the trade was currently up at $282 per spread, 151% return. All right, so that was where that was going out. Again, this was kind of a shorter one, but really nice setup, and we wanted to have positive theta for it, and that's why we did this trade. So set the trade up right here. You can see our indicators are giving us a buy setup, momentum, and then we took trade adjustment here with a little profit, and then close out the balance of the trade right there. All right, so here's the kind of first part of the trade. We had this long the 7 Feb 53 call, short the 24 Jan 55 call. That cost $1.95, $195 per spread. And then we did an adjustment on the 22nd. All right, so we adjusted the trade to reduce our theta and also to give us a better potential profit, widening out the spread and reducing our risk. So now it was trading, so we did an adjustment to this trade. It was trading out 57.45, and then, but also what we typically will do, we'll take some profit the day that we adjust, and then we'll hold the adjusted trade. So then we had this trade set up on, where now on the 22nd we did the adjustment. It was trading at 55.06, and so this spread went from $1.95. Now it was trading at 253. So it was up $58 per spread, 30% return. So we'll take a little profit there, then adjust the balance. And then this is what we ended up adjusting it into. We were now long. We widened the spread out. We rolled the long strike up from 53 to 54, locking in some profit, and then sold against it the 24 Jan 58. So $2 wide spread, but we locked in some of the profit from when we were originally long 53. Now we're into the spread here at $1.86, okay? And now we've got a $4 wide spread. And so now that trade had blown out to 483. All right, so 483, we had the spread adjusted to $1.86. Now we're up $297 per spread, or 159% return. So that one is a great one for when you think the market may churn a little bit and then kick to the upside, or churn a little bit, kick to the downside. This is one that we will a lot of times go to. So, today was just kind of a start. As you may know, options are my favorite trading vehicle. That's typically what I always fall back on, and use for any kind of market environment or market we're trading. But today, I can only kind of scratch the surface. So that's why next weekend I'm going to be doing this very in-depth course on the ultimate option guide, when and how to use which option strategy for the best results. So we'll crank up next Saturday at 11 a.m. to about 2 p.m. or however long we need to get through the part one, and then we'll finish up on Monday, the 10th at 4 to 5 p.m. or however long it takes, and then we'll do a follow-up Q&A the next day on the 11th. Okay, so again, use that special link. If you sign up today, you're going to get that discount of 15% off, and so we'll go back through that and then use that OP15 and use that for your promo code to get the 15% off. So with this course package, here's everything you're going to get, and any questions, let me know. We'll go through this in more detail for everybody here. So use it, and it's good for today. So the course will be $197, but if you use that promo code, you're going to get 15% off. It'll be $167. Now, with the course, you're going to get my cycle reversal indicator, which we'll use for helping us navigate the course trade setups that we're going to do. You'll get the reversal indicator. You'll get my extreme range band indicator. Okay, so those come with the course. And again, if you want to check the prices and more information on these indicators, you can go to my powercycletrading.com. And you can see those two indicators there. And then you're going to get my Option Masters Trading Workshop when I did prior. Now this one's more geared towards the Greeks. You'll get that. And then you're going to get my price target mapping. This is what we use to map out our targets up or down. It's a very big part of how we're going to set up trades in the course. So that's $297 on my website. And then another option course you're going to get is Start Trading Options Today. And then you're going to get 30-day trial membership. You can start this when you want. So if you want to wait till after the course, you can. If you want to then, renew, it's $97 a month, or we have other packages that you can use. Then we'll do that follow-up Q&A. And then you're going to get my option tutorial with the Greeks, more on that. And then 15 option strategy guide. So another really nice add-on there. So get all that. So it comes out to over $3,600. Use that promo code. Today you're going to get everything there for $167. So really, really great course. A lot of interest, from members and clients wanting to, have this course to see, when would I use the butterfly? When would I use the, Debit Spread or Condor? So this will really take you through all the steps to help you have that more clarity to it when to use it. So then if you want to check out anything that is being offered here, you can see everything here. So here are all the courses. You can come down here and you can see all the different courses that I'm adding to this as the trade bonus. You've got Fibonacci course down here. There's the calendar diagonal course, but anyway, you've got all this you can check out. So here's my Fibonacci course. You're going to get this as part of the bonus package here, so $297. Anyways, so go there, and then if you want to check out the indicators, more detail on that, but you're going to get these two indicators as bonuses that we're going to use these in the course. So you'll get the this one right here, my cycle reversal indicator, and you can get good for Thinkorswim, TradeStation, TradingView, Wealth Charts. Okay, so you can get that, and that is $197 on my website. And you can also, you're going to get my extreme range band indicator. We use this in the course as well. Good for Thinkorswim, TradeStation, etc. So again, $197. So that's where you can go there, just if you did want to check out any of that. And then if you want course package 2, this will give you all the alerts, and this will be for the next 4 months. Again, you can start and stop this whenever you want. So if you're going on a business trip or vacation, you can stop it so you're not using your time up. But this is going to give you my special alerts that I send out. But there are 5 different types of alerts that I may send out. Again, it could be a butterfly or a condor, could be a calendar diagonal, could be a butterfly pin or a calendar, what we call pin trade, could be breakout reversals. These are debit spreads, credit spreads, or it could be an earnings trade. Okay, so this is will save you tons of hours of research finding these trades. I spend a lot of time every day looking for the different trade setups. And so you're going to get all of these, whatever the 5 different alerts that could be sent out over the next 4 months, plus 4 months of my trading club to be a member there. And so the course package and everything in course package 197. So this is $597, but today if you use that promo code, you'll get this for $507, and there is a 2-pay that you can use as well. Okay, so really great. We've had great success with this trade alert service. Again, we've been since started it back in 2019, 2018, part of it, and gone through 2025. So 5, 6, 7 years basically of this. Yeah, so up here under option mastery course, Joseph, that's correct. All right, so those are the different types of alerts that will be sent out. And then when I do send out alert, a lot of members just do they just want the trade set up. So they may just go long calls or long puts, or they may just do the shares. But when I send the trade out, I will always give you an option spread that I think's relative or appropriate for the market condition, exactly like I'm going to teach you in the course. I go through, this is my process that I go through when I send out alerts, so as to the best option spread based on the market condition that we're trading in, the chart patterns, etc. So this is exactly what you're going to learn in this course. So then, at the end of the day, I do a trade setup video review of the trade that I sent out. Trades are listed and archived. Then as well with the alert service, you're going to get 4 months of the trading club, which give you, we do a weekly live and recorded Q&A every week. So you'll get that for the next 4 months. Do a video newsletter every day after the close for the next 4 months. Access to the virtual trading room. This is where you can come into our virtual trading room each day during the week. So this is open from 9:30 Eastern to 10:30. So come in and see what we're doing there. If you have any problems with the trade, any trade ideas you want to have reviewed in the room, you come in there, ask questions. And then plus you're going to get 60% discount on anything on my website. Any other course that you might want, any software, you can get 60% off as a member's code. You'll get when you sign up for the next 4 months. So really great access to all my indicators and other courses. And here again, just a summary of the alerts. So started the first alert service back in May of 2018. All right, and then about 8 years ago. Wow. And then here it was through yesterday, 22, 28, 25. So we've had 839 trades closed out, 605 winners, 55 break even, 179 losers, running at 79% win rate. We've been up to 80, 81%, but just try holding right around this area here. I like to keep the win rate really high. And again, these are unaudited, but the summary of the trades. And so just try to keep the trades really high percentage winners, the way that I do everything. So yeah, does the course package 2 include what was in? Yes, it does. So good question. Okay. So here, everything that you see in course package 1 that you're going to get with a discount of 167, you'll get all this in course package 2. So course package 2, the difference is course package 2, you're going to get the alert service plus the trading club for 4 months. Okay, in this package, you do not get the alert service. You get the trading club for 1 month, but if you do package 2, you're going to get the alerts for 4 months, all 5, the different ones that I might send out, plus the trading club for 4 months. And it's going to be today, 507, there's a 2-pay, but you're also going to get all this. You'll get the 2 indicators. You'll get the option masters course. This is more geared towards the Greeks. You'll get the price target mapping course, get started trading options today, option trading tutorial, and the 15 option guide. Okay, so that to clarify, that is exactly what you're going to get. All right, so everything in course package 1, but you're going to get the alerts and everything's 507, and there's a 2-pay if you want to take advantage of that. All right, so that's the kind of summary there. And then again, use that promo link, powercycletrading.com, if you want to take advantage of the discount. All right, click on that. And then again, make sure to use small cap OP15, and that'll give you the 15% off. So to get in summary again, you can do either course package 1 with all the bonuses, basically 95% off. So 167 today. If you want to add the alert service to it, where you get all 5 of my alerts that I might send out, this, when I go out to my other clients, etc., after today, this will be 597. But if you use the 50% off promo code, you'll get this for 507, and that gives you the alerts, all the alerts for the next 4 months, and the trading club for 4 months, plus everything in course package 1. All right, and again, you can start and stop it when you want, so you're not using your time. All right, and if you want to see if you've purchased it, if you have, it'll say option mastery. And the bonuses, okay, you're going to get these bonuses because we're going to use these actually in the course, okay? So that's just want to clarify that. So these are included free, but these are things that we're going to add and use in the course. So these are things that you're going to need to participate in the course next week, and to help you kind of move through the course, because we'll be using all these tools in the course. All right, so that goes there. Now here's just a little feedback. This was from Dennis, that just finished the OptimMasters course, loved it. Hedging on demand is a game changer and allows one to enter trades with confidence. Already 2 of my probability trades, which were heading to my short strike, were converted to butterflies, which I exited at higher profit than the original trade forecasted. I slept much better, and the funds were then reinvested. Compound interest is a little magic seldom mentioned with options. So from Dennis. So here's kind of a course outline to give you an idea of what we're going to cover. So we're going to look at, understanding how option pricing works to start, the foundation, okay? So we're going to go through the vitals of the option Greeks, how to use them for your option trading. And then again, we're going to go in more detail option pricing, how that works. Then you use that basis for selecting the best option strategy based on option pricing. Again, what the market maker's trading secret is, how to take advantage of that, how to use your standard deviation to give you a probability analysis. We'll go through examples of that to make sure that you understand how to do this analysis, how to set up the expected move to give your theoretical profit targets. And this is, again, will be explained in layman terms, so you're going to understand it. So this is one of the bigger things with option trading, is to understand this kind of probability analysis. So it'll be real clear to you after the course how to use that. And then also how to use option delta for those trade probabilities. So all the trades that we go through in the course will be using the option delta, and also Thinkorswim platform, which gives us the probability. So you're going to get, this will be all totally clear to you. And then how, why, and when are we going to take advantage of volatility and the volatility skew, what that is, how to take advantage of skew. If you ever wondered what skew is, we're going to go through that, how to use that in your trading. And then step 2 is the option strategy guide. So we're going to go to, in this part of the course, then what option strategy to use. And again, we're going to go through the kind of step-by-step process for setting up the best option strategy for the swing trade. So we're going to look at the cycle that we're in, up, down, or sideways, the chart patterns. We'll go through all 5 of those to show you what those are, what I'm looking for there. And then how to assess and evaluate the market condition we're trading in. So we want to quantify that as to uncertainty. Are we high, low, or extreme? Okay, that's going to be a big part of then what option strategy to use. And then what is going to be our time horizon or trade duration. So we'll go through all this in greater detail for the different trades. And then we're going to go through step 3, process for selecting which strategy to use and when. So we'll go through the best option selling strategy, what they are, how to use, best buying strategy, what those would be, how to use. And then we're going to go through the option butterfly, which is just an amazing trade strategy. So it really takes great advantage of the uncertain markets and high volatility markets because we've got that component where we're selling time and volatility, which gives us an additional hedge, reducing our capital at risk, plus also reducing our theta. All right, so how that works. And then the butterfly, then also, you get these potential returns of 100 to 1,000% or greater, which you saw an example here earlier, with Tesla. So that's a big part of what we're going to cover, that one, trade strategy. And then the major trading advantages for using the long option condor. So this is another really great one that do a lot of these, great for hedging. So we'll go through that for hedging, how that's used, how, why, and when to use the long condor spread, okay? Sometimes we use it, sometimes not. Sometimes it might be better to use the counter diagonal. Sometimes it might be better to use a butterfly. Sometimes it might be better just to use a debit spread, all right? So it's gonna, get rid of that confusion of what option strategy should I be using. And then we'll go into the calendar diagonal, okay? Medium to longer term directional trade that can be used for income option collection, amortizing the trade, how, why, and when to use it. The calendar diagonal works to create a directional trade with defined risk, but also can provide us income and the potential for big profits from market direction. And again, getting paid while we wait. So really fantastic structure. And then we'll go into the different trade strategies, okay? When to use and how to use for hedging, buy an option, calls or puts, vertical debit spreads, calls or puts, butterfly condors, counter diagonals. So these are what we're going to cover in the course, when to use and how to use, and also how we could use and incorporate these in the hedging. And then when I go into hedging, we go through what I call the progression of hedging using options, then how, why, and when to hedge. Okay, we'll go through different scenarios and conditions there. Trading risk management, how to adjust our trades, reducing our risk on those trades, different adjustments we can do with these option spreads. And then what I call matching vertical option spreads for hedging adjustments. And then another thing that we are constantly looking at, can we adjust into a free trade? So we'll talk about what to look for and how to go about adjusting a trade into a free trade where you have zero risk in the trade. So you may have started off with a risk maybe $200 per spread, but we'll go through some really good guidelines of how you can, in certain situations, adjust that down to zero risk, or even sometimes adjust the trade into where you're now getting a credit versus where you may have started out with a cost of capital of a debit cost, okay? Resources, we'll go through how assignment risk works, expiration, auto exercise, standard deviation, more comparison there. And then you're going to also get an option trading library. So this is a great way to look at past trades, a lot of different trades that you can go kick the tires and see how they work, giving you a better idea of exactly how they work. Yeah, you're welcome, Michael. And here, you can also, let's see, hold on one second. If you want to join us again here, 1 second, you can. Just a second here. Bear with me here. Okay, check that out. All right, so that's kind of the outline of the course. And then let's go through the enrollment bonuses, and then any other questions, let me know. Thank you there, Ed. Thank you very much. All right, so here's what you're going to get. So we're going to be using these two indicators in the course. So these are coming with the course as a bonus. And so we're going to use the cycle reversal indicator. So we'll go through how that, what this is in the course, how we use it, but this is a reversal indicator based on what we call momentum percentage range band. It's got an upper and lower study. So when we get a cycle reversal, say to the downside, you'll see a reversal. This signals in advance when to potentially we're getting a reversal to the downside or reversal to the upside. So you'll get this indicator. We've got it available if you use Thinkorswim TradeStation or TradingView. It's got an upper and lower study. So this is a really key indicator that we use for all the trade setups that we do. You'll get that. And so just, an example here, here's a cycle reversal to the downside, cycle reversal to the upside. Anyway, it's a fantastic indicator to use. And just try to show you an example here. Anyway, we'll have more time. I can come back to that if you want to see some more examples on that. And then the other indicator you'll get for the course that we're going to use is my extreme range band indicator. So what this does, it identifies price extremes. And so when you get price that is too extended from the kind of the normal mean, kind of what we call the moving average mean, then you get too stretched at certain points, you're going to get either buying or selling exhaustion. And this kind of becomes your first signal that a security is going to start reversing. So very accurate in signaling and advanced potential for your swing trades and long-term trades. So very helpful for setting up, trade setup. So when you start getting reversals and you're getting too overstretched, it's a great indicator to use. And we've got it for Thinkorswim, TradeStation, eSignal, Ninja. So here you can see we had a cycle reversal and we're very extreme stretched on the trade, and it starts to come off right here. So this extreme range band, so you'll get this indicator, and then here's your cycle reversal indicator that you're getting as well. And then, it gives a signal to alert a potential cycle change, and here's one to the upside. Okay, so we'll be using this in the course for really good for certain then option strategies to use based off this kind of pattern, this extreme stretch pattern, either up or down. Bonus 3 is you're going to get my recorded option masters workshop course. This is a 6+ hour course that's more kind of more in depth on the option Greeks. Okay. So more focus on the Greeks, but also goes through the different option strategies to use. So you'll get that. You can start out right away. This is 6+ hour, 360-page PowerPoint course. So you'll get that. You can start with that right away. And then you're going to get my price target mapping course. So every trade setup that we do at Power Cycle Trading, I always go through, let's map out the price targets. And this is the course that shows you how that's done. So very important to, if you have time, go through this course before the course next weekend, but this will show you exactly then how I map out price targets up or down. And it's based on using Fibonacci analysis, moving average analysis, what I call price action, support resistance levels, standard deviation forecasting, and unusual option activity. So a really great course on price target mapping. All right, so 3+ hour course there, everything you need to know on that. So you get that as a bonus. And then you're going to get my other option course, Start Trading Options Today. So if you're just starting out or even intermediate, this is on demand for a training manual with videos, comprehensive guide on option trading. So this course will take you through the benefits of options versus stocks, what you should know before you start trading options, the basics of options, mastering puts and calls, the basics there, how option expiration works. And this also goes into 3 different strategies. It goes through the covered call strategy in the course. It goes through the covered call with the protective put, a collar strategy, and also goes through the vertical debit spread. So another really just good option course to add to your option trading library. So you're going to get everything focused here pretty much with options. And then you get, if you do course package 1, you'll get a 30-day trial membership to my trading club, which you can start whenever you want. Now, if you do course package 2 with the alert service for 4 months, it comes with all this for the next 4 months. So I've got a virtual trading room that opens each and every day during the week, trading week, 9:30 to 10:30 Eastern, Monday through Friday. So If you've got any trades that you need help on, or come in and see what we're doing in the trade room. We're planning trades on the market condition. This week was a pretty choppy market, so we were doing a lot of different, different trade scenarios and things like that in the trade room, kind of, planning out trades, what to do in certain situations. So come in there and see what we're doing there, or if you need help on a trade, come on in there. And then with this trading club, I do a daily video newsletter every day after the close. We also have videos that are archived, so training videos that are in the club for you as well, under the Traders Educational Vault. And then we do a weekly Q&A live and recorded, and then you get 60% discounts. You'll get a members code with that. All right, and so anything on my website, courses or software. And this is one of my members. I like to always point this out. It says, Jay says, reading books is fine, but seeing the actual option trade setup makes a huge difference. Okay, and that's always true. So just come in the room and you can see what's going on there. And any questions, it gives you kind of that avenue to me to ask any questions on any trades that you might have. Usually I have you a pretty good answer on certain things you can be doing. And then we'll do a follow-up Q&A. So we'll probably do this the very next day. Okay, so you'll have that. For additional support plus, you're going to get the trading room. If you do course package 1 for 30 days, or if you do 2, you'll get it for the next 4 months. All right, so you get that. And then you get my option trading tutorial. So this is another option course, 60-page option guide with videos, really focusing on the Greeks, okay? Delta, Gamma, Theta, Vega, how option pricing works, market maker secret, standard deviation, delta, and probability. So just another thing to add to your option trading library to go through. And then one last nice little bonus is the 15 option strategy guide. And this one, if you've ever wondered what the heck is a back ratio spread, or what's a long straddle or strangle, so it's going to go through this course, the trade construction, when to use 15 like other key option strategies that you may want to think about. All right, so there are a lot of different ones. And then one last kind of run through, this is the Elite Open and Close Trade Alert Service. So if you do package 2, this is what you're going to be getting. And this is just kind of a nice feedback from one of my members, Waleed, who's actually in Kuwait. He said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not that great. But one thing I would like people on this webinar to know is when I get the trade alert from Larry and do it blindly, as time has shown me that he is dead accurate in his recommendations. Thanks for your great service. And here's from Dan, one of my members said, you're very diligent and totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took when I was learning how to trade options. So this is another great point. So Dan was learning to trade options now. So you take the course, plus you get the alert service, you're going to be really on the fast track to learning how to trade options. So that was from Dan. Again, here's which, let me give you the link again. So use powercycletrading.com/special, and then you're going to use that promo code OP15, Barbara. Here's the link again, and then you can select from course package 1 or 2. All right, and then OP15. All right, so again, you'll get 5, access to 5 different alerts that I could send out. Could be butterfly or long condors, calendar or calendar diagonals, then specific monthly pinning trades, which could be a butterfly or calendar pinning trade, or it could be a breakout reversal type trades, which could be debit spreads or credit spreads, or selective earnings trade. You'll get, when I send these out, you can, do your own thing, or I will always again send out the exact option strategy that I think is appropriate for the market conditions. So I'll send that out to you, all the details how to, of that trade, and then I'll send out adjustments if needed. I'm constantly monitoring these trades all through the day to tell you, if they're in profit, if we need to watch a certain strike price for, maybe a stop level or adjustment level. So those are things that I'm constantly doing and monitoring, and then picking the trades. It's not easy to find the really good trades, okay? So you'll be getting all this for the next 4 months, weekly trading Q&A videos are live and recorded. uh, video newsletter every day after the close, the virtual trading room every day, next 4 months, and that discounts on everything on my website. All right. So a lot of great stuff there. Now, when I send out a trade, I'll give you the suggested option trade. So the entry level price targets, and this is based on my price target mapping. So it's based on unusual option activity or Fibonacci levels. Now, when I send out the trade, I'll tell you what option series to use. I'll give you the stop loss guidelines and profit target guidelines. And the trades are listed in archive. And then I'm constantly monitoring these trades, giving you updates, on the trade. So, I use a service called Telegram. So this is one that we set up on Friday. This was a new GLD short trade. And, these are all the different alerts that I send out. We had last week, we had a trade that were long STX that we were in. We were in this for a few days. We took it off for a small profit last week. That was that. We had a short trade on the Russell 2000. We took this off for a nice profit on Monday. That was a short trade we had. We had just a lot of different trades you can see here. Before that, we had on, this was an earnings trade we had on AKAM. Let me show you that one. Here's the NVIDIA trade I just showed you earlier. That was the NVIDIA trade. We had this earnings trade on AKAM. This was a really cool trade. So just a lot of stuff, and these are all sent out with this free alert service called Telegram. Hey, thanks, Salvasar. I may show this everybody. This is from one of my really great members. Appreciate that input. Hey, thank you, Shamash. Yeah, I'll do that right now. And this is from another one of my stellar members. Appreciate this input. Sorry, that's the wrong one. Here, hold on a second. Then I'll get that to you. And then any other questions, let me know. Here's another nice, appreciate this. Okay, here you go. Hold on. All right, I think that's. All right, so then I'm constantly monitoring these trades throughout the day, so you don't have to do it. And then I'll do, at the end of the day, I'll do a trade set video review of it. And again, I'll do a video newsletter every day after the close. And then we have a weekly Q&A live and recorded. Then you have, again, access to the virtual trading room every day during the week from 9:30 to 10:30 Eastern. Discounts of 6% off on anything on my website, any course, any trading software, and the Traders Educational Vault for my members. And then here, just the calendar alert service started this back in 2019. You can see here, and then through yesterday, we've had 326 trades closed out, 236 winners, 19 break-even, 71 losers, run at a 78% win rate. Again, unaudited, but this is a summary of those. We do a lot of these because these are what I call flexibility trades. You'll learn what that means in the course. Okay, and then here's that one I showed you on CCJ. I'll just kind of flip through here. This one we did just recently. And this one we ended up, making over 297 per spread, 159% return. Here's another one that was really cool. This was on XLE, the energy ETF. And we did this was doing a long call counter diagonal. Now this one we converted to a free trade, adjusted this to a free trade. So this goes through, all the details. These are very detailed when I send things out. I'll tell you exactly what to do. And then if you're in the trade room, you can also ask questions about that. All right, so this is, all that. And then set this into a free trade. Converted this to a long call condor, which was ended up having no cost to it. So got into this trade. I'll just kind of run through it here. We set up here was a cycle reversal. You'll get this indicator. And then we had our momentum going up. So we got into the trade here. We did adjustment here, and then we took the trade off here. So we ended up adjusting this into a long call condor free trade where we had zero risk on the trade, and then took profits. So this was a really cool trade. This is the ultimate outcome that we're looking for. Okay, so I didn't go through in this example showing the other adjustments, but here's what we ended up with. We ended up with this long call condor, which you'll learn how to set this up when and how in the course. So this thing was going out. We were up at 90.53, and we adjusted this into actually a credit where we had zero risk. We actually had $3 credit to the trade. So it went from a credit of $3 to $1.89, so 189. So this was up $192 per spread, and there was zero risk. All right, it had a lot more potential profit, but we went ahead and booked it there. So that was pretty cool. And that was on XLE. Now here's butterflies. We do a lot of these. And these are the trade summary for the butterflies. Started this back in 2019. We've had 206 butterfly or condors closed out, 147 winners, 14 break even, 45 losers, 78% win rate. Now these, of all the trades, these have very low, on average, a low risk of maybe loss of $50, maybe $70 per spread, but potential to make 2-to-1 to 25-to-1, right? These are unaudited again, but these are the summary of the different trades. And here's that NVIDIA one. I showed you that earlier. So that one we did just recently turned out really great. And then here's one we did on Apple. This was a pretty good one. This was, you can see, new Apple long trading at 228.80, holding support. So very, very detailed to kind of give you an idea of why I'm setting the trade up. Daily positive momentum, upside cross. This is my momentum indicators that I use. Target 1, 232, target 2, 234. Buy a condor. Okay, so it's about the 230, 32.5, 237, 240 at around 85 cents or $85. And then here it is on the 29th. Now it's trading at 235. Currently up around $167 per spread, 203% return. Here it was now, it's trading at 237.32. Currently up around 168 per spread or 204% return. All right, so these are, the alerts sent out, constantly updating. Here was the trade setup with Apple. Very, very selective on my trades I send. So we had a cycle reversal. You'll get this tool, positive momentum, got in here, got out here, beautiful trade. It went from 228 to 235.74. So we nailed that one. And so that was a really beautiful trade. And then we've got, here's the setup. So we had long the 230 call, short the 232.5. You can leg these or you can do them all at once, and I'll show you that in the course. Then we had the credit spread against it, 237, 240. So we had this spread set up, total cost 82 cents or 82 bucks, $2.5 wide spread, less our cost, potential profit in this area here, $168 per spread, 204% return. And this made, went from 82 to 249, up $167, 203% return. Worked out perfect. And here's just one more butterfly lotto trade. We did this was on GLD. And this was one that we set up. We were looking for a move to 230. I'll just kind of briefly go through this. And this one, we made 700% return in an 8-day period. Not quite as good as Tesla, but pretty good. So we were targeting 230 on this butterfly. And so we went on the 8th of August, set it up as 222.85. On the 16th, it was trading at our target at 230.47. So we did this trade setup here for a cost of 29 cents, 29 bucks. So we did that butterfly, $300 wide spread, cost of the trade 29, potential profit 271, potential return 934. We didn't get it perfect, but we got close enough. So in this one, we ended up getting out right there. It was trading at 230.47. It was up $203 per spread, 700% return. Okay, yeah, I'll do that. All right, I'll get that number down. All right, so that's everything. And yeah, here again, Denise, let me, just make sure to use powercycletrading.com/special. Use that.